Hey everyone, today I'm going to talk about BlackBerry stock. It's up over 80% in the past 12 months and it's near its 52-week high. The stock has been rallying in recent months. Let's take a look at why it's doing so well and if it's worth buying right now. So shares of BlackBerry jumped around mid-December. Let's take a closer look at what was behind this jump, which seemed to have sparked a rally ever since. On December 19th, BlackBerry reported earnings. The company said it beat the top end of its revenue guidance for cybersecurity and IoT, which is Internet of Things. It also said it raised the bottom of the full year guidance range for IoT. It said it posted positive adjusted EBITDA and EPS. But keep in mind that BlackBerry is notorious for posting adjusted numbers. And adjusted numbers aren't in accordance with GAAP, and they don't show true profitability. However, anytime a company does better than expected and it raises its guidance, those are very bullish signs and they can lead to the stock taking off, which is what's happened with BlackBerry. But let's take a closer look at the numbers. The company's revenue actually declined on a year-over-year basis, and so did its gross margin. Its expenses came down, and when including its discontinued operations, which is its silence business that it's sold off, it posted a net loss of $11 million. The positive is that's less than the $20 million loss it posted a year ago, but nonetheless, BlackBerry is still struggling with profitability. The company also said it generated free cash flow during the quarter, which it did, but just barely at $3 million. And the problem with cash flow is it can vary significantly from one period to another. The timing of when checks go out and payments for receivables come in can have a big impact on cash flow. That's why it's important to look at a longer term trend. And over the past 9 months, the company's operating cash flow was a negative $25 million. So the company still has many challenges with generating positive cash flow on a consistent basis. The big issue, however, is that this business just isn't growing. It has been in what seems like an endless path of turning its operations around. If you look at the past decade, the company's revenue has been declining. Its growth rate has often been negative. While there have been spikes in acquisitions which have helped bump up its numbers, the overall trend is a downward one. BlackBerry's business is simply not going in the right direction. And a good example of its mismanagement is the Cylance acquisition and now the sale of it. It acquired the company in 2019 and it has now sold it off at a massive loss. It bought it for $1.4 billion US and now has sold it for just $160 million. That's not a great sign that the company knows how to evaluate good opportunities. Back in 2018, when it announced plans to acquire Cylance, it called the company an artificial intelligence and cybersecurity leader. Cylance was supposedly a leading AI company before AI was a big buzzword on the markets and before all that ChatGPT hype. And yet, it not only didn't pay off for BlackBerry, it resulted in a huge loss for the business. John Chen was the CEO back then, and he's since retired. But the problems around BlackBerry aren't going away. The business needs to find a way to grow. While it talks about opportunities in cybersecurity and opportunities with its QNX software and vehicles, the problem is there's loads of competition in tech and in those areas specifically. The company hasn't proven that it has a winning product that can generate a lot of market share and revenue for the business. The numbers don't lie, and BlackBerry is still struggling to turn its business around, almost a decade after it said it would stop making its own phones. BlackBerry stock has been doing well of late, but this is a largely speculative play. The reality is there's really nothing exciting about the business or to suggest that things will get better anytime soon. It's a meme stock at best, and it might seem like a tempting stock to gamble on, but it's not a good investment. Until the company can prove that its financials are in much stronger shape, I'd stay away from the stock as it's likely to be a volatile one for the foreseeable future. That's a wrap for this video. If you like these types of videos and like my unbiased analysis, don't forget to like and subscribe. Thanks for watching.